Hey everybody, Brian Shannon here from alphatrends.net. It is Friday the 24th of July 2015, and we had a tough week for equities. Hopefully you didn't get caught up in it too badly if you did lose money, but some of the leaders have been underperforming a little bit lately. The Russell 2000 lost 3.2%, and the biotechs lost 4.9% for the week after a pretty tough day here today. So let's go ahead and take a look at the charts, and then we'll analyze it a little bit further. This is the year-to-date chart of the S&P 500. You can see that our entire range is based off these lows in February up to the highs that we had seen just back here. And when we look at this market, we are basically back towards the middle end of that range, and that dark dotted line there is the year-to-date volume-weighted average price. So the average price that the S&P 500 has traded at this year, based on dollar amount, is right here at this level of 207.72. And we came down to that level today, and as I had pointed out on StockTwits, that it's also an important level because if we look at the lows of 3.5 weeks ago to the recent little bounce high, it also lines up with a 2/3 retracement of that move. So what we're looking at here is from this low to this high, 61.8%. We came right down to that level, and of course this had been a prior area of important consolidation near about 207.50 as well. Moving to a intraday time frame where we see on 30-minute candles, we started out the week on a positive note, then we started to turn sideways a bit, and in here I was telling Alpha Trend subscribers that we're not quite bearish yet, but when we make a lower high and a lower low below a flat to declining 5-day moving average, then the intermediate term trend turns lower once again, and that it doesn't make sense to buy while we're below that. It made sense to be involved in the long side from here basically to here, and now it's still the path of least resistance is lower. Now we've got a couple things in this area. We've closed that gap. We've got the volume weighted average price and a 61.8% retracement, and we've come pretty far pretty quickly here in this decline. So it seems to me that it would not be a good idea to short at these levels, but we'll have to keep an eye on rallies and consider them suspect while the 5-day moving average is still declining. Now next week you might get some day trade bounces in here, but we're going to look at it next week as guilty till proven innocent until we can see that 5-day moving average flatten out and we see the pattern of higher highs and higher lows above it. Just like last time, we will not get involved at the low of a move. We won't even get involved right here, but at a point like this, and then to get out once the market starts to turn back lower. We're not going to catch tops or bottoms, but we're going to catch a very nice chunk in between, and that is our goal to do that. So the resistance was found at this prior band of resistance up in here, and if we continue down this week, then it seems likely that the 204 level would hold as support. We've also got the 200-day moving average just below about 206.56. So again, going into next week, we're in a downtrend here in the intermediate term time frame. There's nothing here to suggest it will turn. We are at an important level, and this is just a level to look more carefully at the market. So whenever we see Fibonacci or moving average or volume weighted average price, it doesn't mean buy. It means take a closer look at the action on a shorter term time frame and see if the buyers are in fact starting to show evidence that they're gaining control. And even for today, where we see just today's action on 1-minute candles here, we were below that declining volume weighted average price for today's session almost the entire day. So sellers are in control. Rallies are suspect until we can see that flatten out a bit. Now the Nasdaq, for its part, we broke some support in here today, and this is where I said to subscribers as well that we've had this nice rally here, and we've come down to a 38.2% retracement at this point. But for the last couple of days, we've been a little bit more neutral, saying that it was time to turn bearish underneath here because that would give us a lower low with this preceding lower high below a flat to declining 5-day moving average. So on the daily time, of course, we broke out 2 weeks ago, and right now it's too early to say that this will be a failed move. Someone asked me, is this a failed move that will lead to a fast move lower? And we simply don't know yet. For now, I'm looking at this market as we have the potential that this prior band of resistance in this general area is going to hold as support. If it fails, then we would be looking for the 20 and the 50-day moving averages to be tested down near 110. So looking at a 30-minute time frame, kind of the same thing. Here's our Fibonacci levels that we can see. We're at a 38.2% retracement of this range here. But the fact is we have a pattern of lower highs and lower lows. So we would look for, if we see a rally Monday, that this is most likely 112.10 to 112.50 is the first potential level of resistance. If it fails to penetrate and then begins to turn back lower again, I would think that there's good opportunities for short sales for more aggressive traders. But you certainly don't want to buy blindly into this prior level of support. Just like I was saying, with moving averages or Fibonacci levels, it's just a place to look more closely at the action and say, okay, now that it's dropped, where has it come from? It's just dropped from 114.5 to 111 pretty quickly and where does it have the potential to find support? We're basically at that level. So let's wait for the market to actually tell us that there is in fact support there rather than blindly buying into it. Let the institutions who have to buy hundreds of millions of shares go in there and provide the support, and once it turns back higher, then we take the ride that they've established for us. There's the Russell 2000. I was drawing this today earlier for a midday video where this has been kind of the trend line support for this year, and you can see that I did it with two lines like that to make the point that trend lines are not just a simple straight edge. They are a band of support or resistance. They are, they need to be drawn with a crayon rather than a pencil. So this is our bigger potential area of support in the Russell 2000 down here. We are right now at that trend line. So, if we get a little bit of a bounce next week and then it fails to hold, then on the way back down, we would expect that it will likely come down towards the 120 level. And that's pretty close to the 200-day moving average as well. So it seems like a likely target for this market. And again, I'm not looking for the top. I don't spend any time saying, is this the top? We're aware that this has been a very important level on the weekly time frame where all of 2014 it pretty much acted as resistance. We've seen it test it and hold as support. So if it fails to hold this time, we don't want to sell it short after a decline if we was to break it down, because we get those cheap lows and then they rally up, find resistance, and then you want to short it on the way down. If that's the scenario, it's one potential scenario. We simply don't know what's going to happen. That's too far ahead to kind of plan for, but we're into this area where perhaps we'll find a little bit of a bounce, and if so, we're still guilty till proven innocent, meaning expect that rally attempts will fail while we have a declining 5-day moving average. Some people say, hey Brian, that was great hindsight, your analysis. How come you don't tell us what to do? And I'm not here to tell anyone what to do, but to say expect the rallies to fail. That is the call until we can see it back above a flat to rising 5-day moving average. It is guilty till proven innocent, meaning expect rallies to fail and wait for evidence before the buyers actually come back in. So the semiconductors continue to be brutalized here. Let's go back to that chart again, because right now the semiconductors this week lost 4.2%, which actually took them negative for the year. So if you recall, they were leading for a while on the way up, and this was a failed breakout, which led to a fast move lower. So in the case of the Nasdaq, we're not there yet. We don't have that evidence. We see this prior resistance right now seemingly has the potential to become support, but we'll eye it with a little bit of caution, in particular because of the semiconductors and the fact that this is a big part of all of the technology stocks. Semiconductors go into all those into the manufactured products at the end user, and it tends to lead the Nasdaq. So this does give us reason for concern. We've got a pattern here of lower highs and lower lows. We're below a declining 10, 20, 50. we're below a declining 100 and 150-day moving average, and the 200-day moving average flatten out. So we're at this important level. We're at new lows for the year. And again, guilty till proven innocent. We rallied up just shy of, or just up through that 5-day moving average this week, but the 5-day moving average was still declining, and it was a prior level of support as well. So when we have prior support levels that come together with a moving average, it adds a little bit of significance to that level, and we want to be extra aware of it. Going back to the Russell real quickly, I did want to point out, so again, we rallied right up to the declining 5-day moving average this week, and we were ready to get a little bit more cautious and optimistic on this market if it were to get above this level. So we said if it can get back above there, and this would be the scenario to see it happen, then we would have been bullish. But we don't want to be bullish while the market is still declining. We want to be bullish when it's, or start to become bullish when we reach that equilibrium, and then wait for price confirmation. So once we see the stabilization, that's where we want to anticipate, and we want to participate when we have actual evidence that the buyers are gaining control. Now, the financials have broken out as well. We knew that, and they've just been super choppy this year as well. But they did break this prior band of resistance right up in here, and now we're pulling back once again. So, the financials experienced a real nice rally. So let's take a look at our Fibonacci in here as well, and we can see that a 38.2% retracement brings it down to 2505. Today, what we had been seeing actually for the last couple of weeks, let's just go back to this. This is this pattern of higher highs and higher lows above a rising 5-day moving average. So when we saw yesterday that it failed, I said, if it breaks below this level, it's likely that it will continue lower because we'll have a lower low with a lower high with this declining 5-day moving average. So going into next week, despite the bullish picture on the daily time frame, we go into it with a lot of caution until we can get back above probably 25.45 or so, and then hold above that level. If we can get above there and hold, and then maybe rally, it continues. But for now, below a declining 5-day moving average, it's guilty till proven innocent. Biotechs, as we said, lost some pretty good ground here today. You can see on this 10-minute time frame that, it got up to, let's actually back up to a daily time frame. Now, here we have the potential for, from a failed move comes a fast move lower, but we're still in this longer term uptrend, of course. And on that daily time frame, we had broken out. Now, we failed pretty miserably, though, so that's really something for reason of concern. We've got the 50-day moving average, which has acted as support numerous times, although not every single time. So you don't just blindly buy at a 50-day moving average, but be aware that the 50-day moving average is down there, and it's likely to bring about some short covering from people who are short in here. But right now, when we look at the Fibonacci, you can see that off that most recent rally, we're down to a 61.8% retracement in here as well. And now we're going to be considered guilty till proven innocent in the intermediate term as long as we remain below that declining 5-day moving average, and as long as we remain below this prior band of support in here. So 390 to 392 is what we would expect to see continue hold as resistance. We sold off pretty hard today, so perhaps we get a little bit of a bounce if that's the case. On the intermediate term trend, I would be looking for more downside, in particular because we had seen some of the heaviest volume in quite a while in the biotech, so there was a real rush to get out of this market. The year-to-date volume-weighted average price is well below us at 350, and if we take a look at the volume-weighted average price of this last rally, so we can go basically from this point, you can see it has broken that as well. So 386 is another, nearer term level of potential resistance going into next week. I will only bring it up. I don't like gold. You guys know that. It's in a downtrend. It's broken. It's been broken for years. Since it broke here, it entered a longer term downtrend. And as I say, if they don't scare you out on that initial move, they will wear you out as it continues to drift lower. We've got a declining 50, 100, 150, and 200-day moving average. Gold is in a downtrend. Unless you're a super aggressive trader, there's just no reason to be an owner of gold. And the same would go true for the for oil, which lost some good ground this week. We're coming back towards those lows from earlier in the year, and that's obviously good for consumers at the gas pump. But just it's in a downtrend. Do not try to buy the low. Wait for evidence that it's actually turning. The shares of the bonds, that is, we've still got a declining 50-day moving average. Now, we did see a higher high. What I think is most likely in here is we could continue to move up a little bit. But, as far as buying this break of this higher high, these generally are not good purchase areas because you have to ask yourself again, where has it come from to get to that breakout point? In the prior 6 days, it rallied from 115.5 up to 120.5, a 5-point move or about 4.5%, and then it breaks out. Now, if you bought it there above that 120.5 yesterday, obviously, yes, you could have made money, but you're in it a little bit later. This is where if I was looking at this and someone asked me, what do I think about buying it here yesterday? I'd say, it's just rallied 4.5%. Where has it come from? If you wanted to put your stop down here, you might want to get involved in it. But where does it have the potential to go before it's likely to find resistance? And we're basically right in that area. So I think that the best case scenario for bonds is if you're looking for a turnaround in them, that they come down and then see if they can hold above that 50-day moving average and then perhaps begin to turn a little bit. But even then, we've got a declining 100, 150, and 200-day moving average. So I just don't see the bullish scenario for bonds for anything more than a bounce. Obviously, there was a lot of big movement in individual stock prices this week. Apple had run up to its prior band of resistance in here and then sold off on the earnings. That gap occurred 3 days ago. And today we broke back below the volume weighted average price since that gap lower, telling us that the sellers are in control and we have a declining 5-day moving average. I just don't see an advantage to being an owner in Apple right now. Below us, we have, of course, tested that 200-day moving average a couple weeks ago. Perhaps we're in for another test of that. Amazon had a huge day today, but even on this huge day, if you weren't in it, then the volume weighted average price for today, meaning the average price people paid for the stock, was 551. So the average buyer of this stock today is out at this point about $22. So there's obviously some good profit taking, as there should be with a stock that's had such a significant advance here. We had some great trades this week in individual stocks, short JKS, short Pay, Verifone, and other ones. Come take a free look at a week of alphatrends.net, and maybe it can help you as well, especially now that things are getting more turbulent.